Hello, everyone. Welcome back. This is a monthly update and outlook presentation on our flagship model portfolio called the Zacks Earnings Certain Portfolio. I'm Mayur Thaker. I'm an analyst and senior relationship manager here at Zacks Professional Services. I also co-manage this portfolio as well. And let's get started. So as we have been talking about over these past several months and years, what is the earnings certain portfolio? Let's just talk a little bit about the strategy behind this approach here. And it's very, very simple. As we can see, there's just 3 points. Buy quality, don't overpay, and do nothing. Very boring, very monotone, if you will. But this approach is what has contributed to the phenomenal results that this portfolio has delivered over the years. We'll take a look at a little bit more about that. So let's unpack each of these three steps. What is quality, and what do we mean by don't overpay? And then what is it that, by doing nothing, what exactly does that actually achieve? So what is quality? Quality is defined as consistency. Consistency in what? Consistent earnings per share growth. That's the first and core tenet behind our stock selection. But then those earnings need to be backed by consistent cash flow growth. Remember, there are issues with accounting. Sometimes companies report great earnings, but those earnings are not backed by cash flow generation. So we want to make sure that these companies that we're picking, first and foremost, have very, very consistent, very visible earnings growth. And it's not just consistent for a year or two or three or even five. We're looking for long-term consistency in earnings per share growth. We want evidence that these companies have lived through various macroeconomic environments. We want them to have, delivered consistent earnings growth through all of those environments, through recessions, through high interest rates, through low interest rates, through other exogenous shocks to the market. We want long-term results. And those results to be backed by cash flow growth. And we want to be picking companies that have attractive returns on capital. Remember, we kind of want to avoid capital-intensive businesses, companies that, require a lot of investment and produce very little returns on those investments. We want to avoid those types of companies. So these 3 points are made possible due to companies that have durable businesses, right? These are companies whose products and services are always in demand, regardless of what type of environment we're in. It does not require, strong bull markets. It does not require low interest rates. It doesn't require the wealth effect where people are spending, like crazy. We want companies that have proven durability with their business model. Companies that continue to deliver consistent revenue and earnings growth through good times and bad times. And we want them to have established economic or brand or R&D moats. So as you'll notice, some of the names that we have in this portfolio have very, very strong, visibility with regards to their brand or with regards to, doing things that give them an R&D mode. For example, Mettler-Toledo is one of them. This is a company that is, world renowned for their precision lab instrumentation. We'll talk a little bit more about them a little bit later in this presentation here. But we want durable businesses and we want a strong moat that protects that business. So these are the 2 principles that lead us to finding companies that have, consistent earnings per share growth backed by cash flow growth. So the key word here is consistency. That is why we call this the earnings certain portfolio. It is certain because these are businesses that have strong durability and moats, and therefore produce consistent earnings and cash flow growth. And this is what is the ultimate result right here. This chart that shows us the actual earnings growth of this portfolio over time. And as you can see here, during the shaded regions, the shaded areas are recessions. And you can see that the orange dotted line here, which represents their actual trailing 12-month earnings per share at each point in time, throughout the 2001 recession, throughout the great financial crisis of 2008, 2009, and during the COVID disruption in early 2020, you can see that these businesses continue to deliver strong results through these recessions. And of course, there are drawdowns during that, the stock price is obviously outside of our control. But we believe that by picking companies that have very, very durable businesses that continue to deliver results in good times and in bad times, we think that we can generate strong risk-adjusted and cumulatively better returns over time. And that's exactly what we've done. So let's look at what the performance is. This is the actual performance of our earnings certain portfolio versus the S&P 500. I will caveat this where returns prior to 2012 are back-tested results because we haven't been running the portfolio for that long. But if we were to continue using the same exact strategy, holding the portfolio that we had in 2012 consistent prior to that, then you can see that the drawdown in 2008, 2009 was almost half of that of the S&P 500. So this is this is exactly what we'd like to see here. This is a portfolio that is built to outperform, especially during down markets, especially during recessions and bear markets. Remember, these companies are recession resistant, if you will. As we saw in the prior slide here, these companies just deliver results year in, year out. Not to say that they don't have drawdowns in the stock price, because of course everything gets hit during recessions. Everything gets hit during market turbulence. But the idea is to get better results to the downside relative to the S&P 500 during those times, and that's where you can see that right here. So our drawdown in 2008 to 2009 was about 30%, which is very, very difficult. But compare that to the S&P 500, which had a top to bottom drawdown of about 50% during that time. So that was strong excess returns on the downside. And you can see that, that carried through, during the upside. So even though the S&P had a very, very strong recovery, we actually had a strong recovery equal to that, just about, during that entire time. So the time to recover that drawdown was almost half. As you can see here, we recaptured the all-time highs, by late 2009. And yet the S&P took almost, an entire year longer to recapture that, almost a year and a half longer, as you can see here, recapturing that all-time high. So this is the value that we add in the portfolio, is that our drawdowns are limited versus the S&P 500, and yet the upside remains just as strong as the S&P 500. Now, I will say that during exceptional bull markets, the S&P does outperform, but cumulatively speaking, we do much, much better. If you were to capture both a recession and the subsequent recovery, our portfolio outperforms quite significantly. And you can see here the excess returns by year. And here is that result. So obviously we had that strong outperformance in 2008. But we also outperformed in 2010, 2011. We underperformed during strong bull markets, right, in 2013 as well as 2012. But we once again recaptured some of that in 14 and 15, lost some ground 16 and 17, recaptured in 18, lost, in 2019 through 2021. But you can see here, now that we have a strong, downside, with the S&P, really declining by about 10% here year to date, or at least quarter to date, a little bit more year to date, you can see that once again, our portfolio is outperforming. So the cumulative net effect of all of this is that we believe that the excess returns on the downside more than outweigh the lag, years to the upside here. And so that's why we can, generate these types of cumulative outperformance over time. And here you can see that exactly what happens during, up markets. We outperform over, cumulatively speaking, by about 2.65%. That is the cumulative annualized excess return. But you can see here that we do underperform during up markets here. So you can see that second point right here is that during up markets, right, we underperform by about 6.2%. But then during down markets, we outperform by 10.6%. So, the outperformance to the downside more than outweighs the underperformance on the upside. And that's why we believe that we can generate strong, excess returns, cumulatively speaking. But at the same time, we also deliver much better risk-adjusted returns. So we believe we can get better results, and we have gotten better results, cumulatively speaking. But also on a risk-adjusted basis, you can see here the Sharpe ratio is 0.97, and then compare that to the S&P 500 at 0.64. Again, on a risk-adjusted basis, we can get much better results. So you can see here on a mean basis, the average return, monthly return, is about 1.07%. That's for our portfolio strategy versus 0.9% for the benchmark S&P 500. So we're doing better on a, just a raw absolute basis. But then also we control for volatility, right? As we saw on the prior slide, we do much better on downside, versus the upside. And so therefore we actually reduce the standard deviation of returns in the portfolio, 3.76% versus almost 5% for the S&P 500. So again, better cumulative returns with less portfolio volatility. And that's what contributes to the very, very strong risk-adjusted return outperformance, as we see from the Sharpe ratio. So better returns with less risk. That's exactly what we like to see and have delivered in the past, and that's what we think will continue, into the future. So again, in a nutshell, we outperform during bear markets, we underperform during strong bull years, but cumulatively speaking, we outperform. So the outperformance in bear markets outweighs what we lag in strong bull markets, therefore cumulative outperformance. And we do this with less portfolio volatility. As you can see in the prior slide here, our beta is 0.78. So we've got, we can do all of this here with less volatility in the portfolio, low beta and a lower standard deviation of returns versus the S&P 500. And so therefore the key points here is cumulative outperformance and better risk-adjusted returns. So it's very, very difficult to beat that for an actively managed portfolio. So how do we do this, right? We saw the what, right? Which is better returns with less risk. How do we do this? We focus on investing in businesses with strong moats, right? We want evidence of a moat, a brand moat, an R&D moat, other economic moats, strong embedded, relationships with customers, strong recurring revenue. We look for evidence of any of these types of moats. And also we want to focus on core essentials. So these are businesses that, yes, have a moat, but remember, Lululemon has a strong moat, right? They have a brand moat. It's a great brand. Ferrari, or, other luxury car makers have a great brand, but it's not a core essential. So therefore those businesses do get hit during recessions, right? Those businesses will, experience a strong decline in revenue and therefore earnings during, economic difficulties. So we want strong moats, but also businesses that deliver core essentials. So products and services that are always in demand, regardless of the economic environment that we're in. And then we also look for companies that generate or have generated strong returns on invested capital. So we want to avoid companies that are, capital intensive, and deliver very little returns on that capital. So it's okay if you're capital intensive, but if you have strong ROIC, then that makes it worth it. So this is the 3-point principle that we're looking for here. Strong moat to the business, focus on core essentials. That's what gets you that earnings consistency. And strong ROIC, that's what gets you the strong returns on shareholder value. That's, the combination of all three is what gets you strong long-term earnings per share growth. So that is the strategy that we're focused on. So what has been the sort of story year to date in 2022, I should say, and that is multiple compression. That continues to be the primary source of negative returns year to date. So you can see here that this is the portfolio, earnings stream over time. But you can see that here that year to date, we have had a decline in the, in our portfolio, with really no change in the expectations of the earnings growth, on average of these companies that we own. So again, what does that mean? It's just purely multiple compression. So we can see here that the ECP 75, as of Q1 2022, posted 10.3% revenue growth year over year and 15.2% earnings growth. And we're expecting roughly, just under 10% growth in earnings for this year versus 2021. That compares to 8.7% revenue growth, 10.3% earnings growth, and almost, 8% year-over-year earnings growth for 2022 versus 2021. This is after digesting Q1 earnings, management commentary, and this is what the ultimate result is. So we are actually doing much better than the S&P 500, fundamentally speaking, on revenue and earnings growth, as well as full year expectations versus 2021. And what has worked so far? We can see here that this has kind of been these the sort of the story so far this year. But let's just take a quick look at what the returns are like year to date. I'm just going to pull up our portfolio aggregation here, and you can see here that we are actually outperforming the S&P 500 year to date, right? So this is exactly what we'd like to see here, is when there are down markets, right? When there is portfolio volatility, we would like to see our portfolio outperform the S&P 500, and that's exactly what we've been doing so far this year. Our portfolio's return is about minus 11%, just under minus 11%, versus the benchmark return of minus 14.4%. So our total active return is quite good at about 3.5%. Now we would like to see this a little bit better. I'll be very frank with you. I'd love to see this, do a little bit better than that. So, although we're beating the market, so we're doing our job year to date here. I personally would like to see this result get a little bit better, because that's the standard that I'd like to hold ourselves to for this portfolio. This is a portfolio that focuses on quality, long-term shareholder value creation. And so I would like to see this number get a little bit better than what we have delivered so far. So although we have added value here, I think that, for the standards that I'd like to hold ourselves to, we think that this is a result that is a little bit underwhelming compared to what we would like to see. But, at the end of the day, yes, we are beating the market. But here is something that I'd like to draw your attention to, which is exactly what we like to see and what we hope will continue if we get further weakness in the S&P 500. So again, the story year to date has been recession fears, has been supply chain disruptions, has been, persistently high inflation, and therefore margins are really weighing on the S&P 500. So we've had, quite a decline in the market this year so far. So we have beaten the market, although again, by just about, 3.5%. I'd like to see that, widen. And look what exactly has happened. So here is one silver lining that I'd like to draw your attention to, which is the quarter to date returns of the S&P versus our portfolio. Remember, the bulk of the decline this year has really has really happened in Q2 of this year. So starting, in April of this year, but really accelerating this month in May. And this is where the separation has started to occur, in much, much greater extent. You can see that quarter to date, the market is down 10.2%. So really, of that 14% decline year to date, 10% of that has come just this quarter alone. So therefore, during the quarter in which volatility really picked up, you can see that the excess returns has actually expanded versus our portfolio. So that is exactly what we would like to see here. That is a very strong result, over 500 basis points of excess returns quarter to date. So right when things got really dicey for the market, that's when our portfolio has really proven its worth. And we have declined by a much lesser extent, almost half of that volatility, half of that downside capture, half of that drawdown, I should say, for our strategy versus the S&P 500. So again, we think that if the market does decline further here, if we do get further deterioration, if earnings start to get revised down for the S&P, if recession risk does continue to be a factor that weighs on markets, we think that this outperformance will really continue. And that's exactly what this portfolio is built for, is downside protection. So we're doing our jobs year to date, but I'd like to see that, expand a little bit further. And I think that's what the proof is in the pudding right here. Precisely when markets, accelerated the losses, that's where the separation started to occur with our portfolio. So that is very, very encouraging to see here. So what has worked, right? And this is where I get, even more, bullish for the portfolio. So, we have outperformed the S&P 500, but I think that outperformance could actually get much better here. And it's because some of the companies that have really weighed us down, such as Intuit, Walmart, and Mettler-Toledo, continue to be exceptional businesses that have continued to deliver very, very strong results in Q1 so far this year, as well as their guidance for the full year. Now, we've done really good with some of these companies right here, year to date. AmerisourceBergen up 18%, Dollar Tree up 16%, Amgen up 14%. But these companies on the downside is what really kind of weighed on our return. So even though we're beating the market, we've had some really exceptional declines on some of these companies that we do own. So I wanted to draw your attention to both the good and the bad. So I want to, be completely honest with you and kind of show you exactly where our, success stories are this year, as well as what has not worked this year. So by taking a further look and unpacking exactly where some of, the biggest decliners have been, I actually start to get even more bullish on the portfolio, because I believe that some of these, declines are purely multiple compression, because these companies like Intuit and Mettler-Toledo especially continue to strongly guide on revenue and earnings for this year, and have delivered very, very consistent results on a very strong and increasing moat that they enjoy. So let's just take a quick look at each of these 6 companies as a recap here. AmerisourceBergen, who are they? They're at the center of pharmaceutical sales in the United States. They generate a staggering $200 billion in annual revenue in 2021. They are one of the largest pharmaceutical wholesalers in the world. They handle almost 20% of all pharma and drug sales in the U.S. It's an exceptional business. They're right at the center of pharmaceutical wholesaling, right? They are the distributors of drugs all across the United States, as well as Canada and other countries as well. They have an exceptional track record of generating shareholder value, even through difficult macro environments. Very strong revenue growth with M&A and organic, 17% year over year. Q1 earnings growth was 23% year over year. So this is, again, one of the reasons why the stock has done exceptional for us in the portfolio here. This is an anti-recession company. Remember, pharmacy wholesale is a recession-resistant business. Despite, for good or for bad, drug sales are going to be here to stay, regardless of what the Fed is doing. So, we can take that and really use that, to our advantage, right? As a company that, meets all of the criteria that we look for in the earnings certain strategy. They posted strong operating profit growth, stable margins despite inflation. The consulting side may see weakness if we do slip into recession, but overall, this is a business that delivers very, very consistent results, as we'll see in the next slide here. And shares remain very cheap. They traded 14 times this year's earnings, despite superb track record of capital allocation and ROIC. So this is exactly what they've been doing here. Very, very strong growth in returns this year. And we think that's just because the stock has been exceptionally cheap this entire time. You can see the multiple compression, very strong earnings growth, but very, very deep multiple compression that the stock has endured for multiple years here. So this has been basically a coil that has been, really compressed here. And so this phenomenal growth or returns in the stock is really a result of years of multiple compression. We think that this breakout is very, very substantial. We do not want to sell, big breakouts like that after years of multiple compression. So we think that this is very, very strong, a very bullish result. And it still trades at a very reasonable, very muted 14 times earnings. For a company that delivers results like this, high ROIC, high consistency, and a strong moat in pharmaceutical wholesaling, this is a very, very cheap multiple to pay for quality earnings growth like that. You can see that the ROIC for ABC is exceptional at 27% versus 11% for the market. So this remains to be a very, very compelling story, and one that I would continue to own in the portfolio. Second is Dollar Tree. They don't really need an introduction. They're right at the center of driving affordable consumer staples. This is a company that really keeps the middle class afloat, fighting inflation all the way through. They are massive, 16,000 stores throughout the United States and Canada. And in response to the inflation that we've all been talking about, they have implemented a price hike from their famous, everything under $1 motto to now keeping a cap at $1.25. Because remember, keeping everything under $1 is awesome. But the issue that they started to experience is that they had to remove some of their best sellers because they simply could not procure them at under $1. So if they were to keep it at under $1, they'd be selling it at cost or even below cost. So that's obviously not sustainable from a business standpoint. So they did now increase that price to $1.25. So although that is a price hike, that is a increase to the cost of living for millions and millions of people that shop there. So far, there's been no evidence that price hike has dampened demand. So it's, continuing quite well for them while going a long way to support their margins. So they want to keep prices as low as possible. Management did this under a lot of consideration. They really, really want to do everything they possibly can to keep prices down. So this price hike from $1 to $1.25 came after decades of keeping prices at or under $1. So any price hike, as you can see, their track record speaks for themselves. It takes a lot for them to raise prices. And so they finally did that. And that's, going quite well in terms of the shareholder reaction. That's why the stock is up so nicely this year. And they continue to post strong growth, 2.5% same store sales growth in Q1, guiding for mid-single digit growth in 2022. And this is a company that does 30 to 35% gross margins, right, despite inflation, and being an extreme discount retailer. So this is a very well-run business overall. For a company that sells everything under $1.25, they have strong, same-store sales growth and very strong gross margins and attractive returns on invested capital, just under 10%. So again, this is a business that is extremely well-run. It is at the core of, millions and millions of people that rely on low prices to live, especially selling consumer staples here. And this is the track record that they've delivered over the years. Very, very strong growth in earnings per share over the long term, especially during, recessions, as you can see here in 2008. So again, if you are in that camp where recession risk is increasing this year, then Dollar Tree is one of the companies that you want to be at. And this is a company that just delivers great results long term, that actually keeps up with the market. So this is a recession resistant company that does, returns that really keeps up with the S&P's returns overall. So it's really the best of both worlds. Another one of our success stories year to date is Amgen. This has been one of the greatest biotechnology success stories in our generation. It's been 100 baggers since 1990. 100x return since then. That is just exceptional. And today they have a strong mix of mature cash cow drugs, as well as a strong pipeline in cancer and hematology. So their total revenue across their areas of expertise, which is in cancer, hematology, and inflammation, $26 billion on 85% gross margins. And they're, if you're not familiar with this company, their three top, drugs include Enbrel, which did $4.1 billion in revenue in 2022, which is expected, I should say, in 2022 of $4.1 billion. This is a drug that treats rheumatoid arthritis. Prolia, $3.6 billion expected in 2022. That treats osteoporosis and in postmenopausal women. And Otezla, if you might have actually seen a lot of their, they do a lot of advertising. You might have seen their commercials on TV. That's expected to contribute $2.1 billion in revenue this year. That treats skin diseases like psoriasis, I should say. So these are some of their widely known drugs, but they also have exciting growth opportunities. They are launching a drug, called Amgevita, which is a biosimilar drug, that provides some competition with some of their competitors that have branded drugs in that area, as well as, strong pipeline in oncology. So again, this is a pharmaceutical that has delivered very consistent results. This is, again, exactly the type of company that we like to focus on. These drugs are completely unrelated to the broad macroeconomic cycle. Sales of Enbrel and Otezla are, not going to be affected by what the Fed does. It's not going to be affected by what Russia and Ukraine are doing. It's not going to be affected by, interest rate hikes or by slowing GDP growth. This is, again, exactly the type of company that we love to see here. And the shares remain very cheap too, by the way. This is a company that has consistent earnings results and 10% ROIC, and yet this stock trades at 14 times this year's earnings. 25% free cash flow margins, by the way. That is, again, phenomenal, business management. 10% ROIC, consistent top-line growth prospects, very, very strong pipeline in cancer. So again, this is a business that you really want to be invested in. And here we see, after over a year of compression, consistent earnings growth throughout recessions. But the stock has really been muted since late 2019. And here we see that finally, I think that there's a strong chance of a big breakout in the stock after a year and a half, 2 years of muted stock price returns. Big breakouts after years of muted returns is exactly the type of chart that you really want to be in on the long side, especially when it's being supported by consistent earnings growth and a low multiple at the same time. High quality, consistent earnings growth, strong pipeline, low multiple, and now after years of just sideways price action, we're starting to see a big breakout in the stock price. So this is a business that will do quite well when the macro environment is negative here, in my view. So again, the type of company that really you want to be invested in, especially if you're expecting volatility in the broad markets. So let's take a look at what hasn't done well. Intuit, right? This is one of the biggest losers in our portfolio. But this is a market leader in tax prep, personal finance and small business bookkeeping software and service. We all know who they are. They are the owners of TurboTax and QuickBooks. They also own Credit Karma, which is a recent acquisition. Remember, this is obviously a joke that everybody knows. There's two things that's certain in life: taxes. So Intuit is right there, capitalizing on the tax industry. So that's exactly what we want to see, right? We call this the Zacks Earnings Certain Portfolio. Taxes are quite certain in life, and Intuit makes your life easier when dealing with taxes. So TurboTax is obviously a bedrock of tax preparation, which millions and millions of people rely on. That is a very strong moat that they have in generating consistent results every single year. Investors are fearing, one of the reasons why the stock is down, though, is that investors fear their small and mid-sized business exposure, that does make them vulnerable to a recession, because remember, QuickBooks helps small and medium-sized businesses, perform their bookkeeping services. But my counter to that is that, SaaS essentials like tax prep and accounting, like bookkeeping, are really rarely canceled, right? So even if businesses decline, right, even if small and medium-sized businesses experience a decline in their revenue and profit during recessions, they rarely cancel services like TurboTax and QuickBooks, because these are required to do their tax returns, and they're required to perform and conduct their business. So unless if they go bankrupt, these are essentials that they will continue. So these are subscription services that they will continue and probably won't cancel on. And these services also enjoy strong moats in the form of high costs to leave the ecosystem, right? Because once you're in TurboTax, once you're in QuickBooks, you are starting to build a history of data. So it's very easy to grab historical data and perform reports on historical tax returns and historical, accounting, financial statements for your business. So there's a high cost to leave the system. And it's an ecosystem that, continues to keep people in once they're in. So, this is a very, very sticky business. They also acquired Credit Karma, and that provides, opportunities for them to cross-sell to existing TurboTax users at very, very attractive customer cost of acquisition. So this is why, they've had exceptional returns on invested capital. They generate 42% for every dollar that they invest into their business. And they also have very strong capital allocation CAGR of 65%, which means that they are growing their investments in themselves at a rate of 65% year over year. That is very, very aggressive growth and very, very strong returns on that investment. So in a nutshell, the sharp sell-off this year really appears to be, purely multiple compression with no change in revenue and the earnings trajectory of the company as per their Q1 results this year. So the multiple compression is really because, they entered the year at an elevated 70 times forward earnings. That is now compressed to under 32 times today. So, and this is a company with 20% long-term earnings growth CAGR. So on a PEG basis, it really trades at, 1.5, times on a PE to G ratio. We think that's very, very attractive now. So although, it's, gone, although the stock is really weighed on our returns this year, we think that it's purely multiple compression. As you can see on this slide right here, this stock has really declined quite precipitously, but with no change in their fundamental earnings trajectory. So that's purely multiple compression. It probably did get, quite rich, in hindsight, but we're not in the business of timing tops and bottoms here. We just want to own strong quality businesses for the long term. And ultimately that's what will generate strong returns like we have done so far. So again, this is multiple compression that we think is representing a quite attractive, opportunity on the long side here. And this is a chart that shows you exactly their returns on invested capital. If you look at the very bottom here, they consistently generate 40% plus returns on capital, and that capital has by itself been growing quite significantly here over time. So they're not only rapidly reinvesting cash flows back into themselves, but they earn very strong returns on that capital. So that is the ultimate example of strong capital allocation that we love to see. So for a company that now trades at 32 times earnings with 20% plus earnings growth, that is a very, very attractive valuation in our view. And, given the fact that this is a business that has a very, very strong moat and very attractive SaaS value proposition, we think that this is a very, very strong, long-term value opportunity. Next to Walmart, right? This is on everyone's minds. Walmart, had a very, very weak Q1. Obviously, they need no introduction. They now operate 10,500 stores across 24 countries. They have very strong omni-channel presence, so they are involved in both bricks and mortars and e-commerce. They've competed quite well with Amazon over the past decade or two. They have, actually long-term gross margin expansion. Really, in the early 2000s, they were at 20%. They're at 25% today. They should be in the upper 20% range in the next 5 years. So very strong value creation on the gross margin side as they enter new channels of e-commerce to actually support their gross margins here. But shares were hammered after Q1 earnings. We've all heard about the ongoing worldwide supply chain disruptions, rising wages, persistent inflation compounding throughout the entire supply chain, and also a drop in general merchandise. Remember, that's where the attractive margins are. They make their margins through general merchandise, not really from the grocery side of the business. And that's where most of the weakness was in Q1. And that's why the stock really got hammered after Q1 earnings. Obviously, this is a big holding of ours. But long term, we think that the company remains in the dominant position in the omnichannel retail. So they have isolated disruption risk by pivoting quite well to sort of online sales. They have an 80% stake in Flipkart, which they took in 2018. Flipkart commands nearly 40% market share in total e-commerce sales in India. And remember, in India, e-commerce is very rapidly growing still, with years-long runway. It still has quite low adoption, even though it's been, rapid growth over the past 10 years because of the massive population, right? 1.2 billion population in India. There is, 10 plus years of growth runway left for e-commerce to continue to grow there in India. So Walmart has an 80% stake in that, and that's very, very bullish for Walmart long term. However, we think, and we're just guiding everybody here just to be real and set the expectations. We do think that shares might remain under pressure for the rest of 2022. As the above forces weigh on margins and earnings growth. The PE multiple right now is at 20 times. We think that could decline further to 18 times just because margins and growth are going to remain subdued here. But we remain bullish long-term on its capital allocation, returns on shareholders. But we also, remain bullish because it is a recession-resistant business, right? If we do get a recession, there should be an easing in inflation if that does happen. And if that happens, then Walmart's margins should actually return back to where it was prior to this, entire supply chain inflation-related pressure that they're facing. And Walmart will once again become sort of a flight to quality as it has always been during recession. So this remains quite a strong counterweight to recession. So that's why we're sticking with it for the long term. And if there is a recession, this will provide some strong, support for the portfolio. This is their long-term earnings growth. As we can see here, again, very bullish in the long term, exactly what we see for long-term investors. And then this brings us to Mettler-Toledo. This has been quite a surprising drop, actually. They are the global leader in precision lab instrumentation. They make weighing scales, pipettes for lab, industrial, and food retailing applications. They are a direct supplier to laboratories worldwide. So hospitals, pharmaceuticals, biotechnology companies, and academic applications, they all use Mettler-Toledo's weighing scales, reactors, pipettes, titrators, and all these different types of precision instrumentation, to sort of conduct their research and development. They have a very strong R&D mode. I couldn't say this, I couldn't stress this enough. They make, the most precision instrumentation that everybody relies on with very little competition. There is competition out there. Texas Instruments is one of them. but they have kind of taken different approaches and have, sort of avoided stepping on each other's toes. And so that's why Mettler-Toledo does exceptional at what they do. Long-term, demand growth for lab instruments remains steady. So this is one of the reasons why we have this in the portfolios, because it is recession resistant, because the demand for lab instruments remains steady regardless of what's happening in the macro environment here. This is a company that generates superb, and I want to stress that, superb capital allocation. They generate 40% returns on capital. Again, with a highly predictive earnings stream here. So this pullback in the shares is purely multiple compression in our view. They have delivered 15% earnings growth over the past 20 years, likely to continue for the foreseeable future. They've also had a very strong share buyback program. They've actually cut the share count in half over the past 15 years. So that's exactly what we'd like to see. This is some of the, if you just wanted to get a better idea, not many people really know what Mettler-Toledo is. So these are the types of instruments that they make, precision weighing scales. This is for not just, weighing like, you think of a countertop weighing scale. This is if you want to measure, down to the nanometer, so down to the sort of microgram, if you will, the weight of different items, where, precision, matters with regards to drug development, with regards to, research and development on, in academia. These instruments are basically second to none in terms of quality and precision. So this is a result of years and years of R&D. And they have a very, very strong moat in that regard. So this has been sort of the result of that, right? A strong R&D moat, strong partnerships with their customers over 20 plus years. This is a moat that is almost impossible to penetrate by competitors. And this is the reason why they have had that, consistent 15% growth year over year, every single year throughout recessions and throughout bull markets. That's exactly the type of, company that we want to see here. And that's why we remain very bullish on this drop, on this sort of drop here. It's down, over 30% year to date. And we think that's purely multiple compression. So again, if market volatility continues, we think that Mettler-Toledo will act like the sort of flight to quality that it should be, especially now. Of course, is there further, risk to downside? Of course, there always is. But, it's trading at a very, very reasonable multiple today. So we think that for long-term investors, this pullback in share price represents, a great long, opportunity in the stock. And here is a chart of that ROIC. Again, this is the reason, or this is how they add value for shareholders and compound earnings, quite rapidly here with 35% plus ROIC. That is just excellent, and really demonstrates the quality that they deliver for shareholders here. And a quick note on Intercontinental Exchange. This is a company that we just added to the portfolio as of Q1 2022. ICE, again, is the global operator of regulated market exchanges. They own the iconic New York Stock Exchange. They are a purveyor of global equity, fixed income, and mortgage data services. They have superb execution of their growth strategy through both M&A and organic growth. They've delivered consistent 15% growth. Remember, they are the market exchange globally. So this is a moat that is, classic, right? What could be a stronger moat than being the exchange, where futures contracts, where the world comes to trade, energy futures, agricultural futures, fixed income data, fixed income securities, and others. And they also have a very strong presence in mortgage data and real estate data. So they have an increasingly diversified portfolio in risk management, global market data services. The world comes to the Intercontinental Exchange both for trading and for data. So they are the exchange where all this trading occurs. So they are essentially the they basically are the the purveyor and the monitor of global financial market data. And so that is the ultimate moat that one could have, right? Now, the shares are down 23% just in the 2.5 months that we've owned the stock in the portfolio. So that's not the best return, not the best result that we'd like to see just right out of the gate here. Part of the reason is because of macro, but it's also because they did a leveraged buyout of Black Knight earlier this year. Black Knight is a large player in mortgage data, real estate data services. But this acquisition only strengthens their moat in real estate data. So we think that this is a great acquisition for long-term earnings growth to continue that growth at 15 to 20% earnings growth year over year. It's rated at 23 times, which was very reasonable when we first added it to the portfolio. Now it trades at an even more attractive 18 times earnings, this year's earnings today, which is very attractive given its high quality. So this is, again, a company that has been hit hard purely because of multiple compression. This is not anything to do with a decline in earnings or a decline in margins or a decline in anything else, purely because the market's reacting to that leveraged buyout deal, as well as some just general macro concerns. But long term, if you are long term oriented, this is a business with extremely highly visible recurring earnings, a very extremely sort of durable moat, being the exchange where the world comes to trade. So this multiple at 18 times earnings, we think remains very cheap given their 15 to 18% long-term earnings growth. The peg is now down to basically 1 to 1.2. Again, very, very attractive valuation for a company that, continue to compound earnings at a 15 to 18%, rate year in, year out, despite recessions, despite other, market turbulence here. So in a nutshell, because, although we've been beating the market year to date, right? That's by in and of itself exactly an accomplishment that we'd like to see. We think that, the biggest detractors to our earnings is purely because of multiple compression and not due to fundamental weakness in their businesses, with the exception to maybe Walmart. The other big weighers of our returns, namely Mettler-Toledo, Intercontinental Exchange, and Intuit, those are three big decliners for our portfolio year to date. And after unpacking their earnings and after looking at their long-term value creation, this makes us even more bullish because we're beating the market despite having three companies weigh our returns that actually continue to execute quite well and continue to guide really well into the foreseeable future here. So, that sets up a very, very strong sort of second half of 2022 in our view. If the market continues to decline further, we think that these are businesses that will continue to do well relative to the market because of their anti-recessionary sort of nature of their business, and because they've already had that multiple compression that typically occurs, when there is market volatility anyway. So in a nutshell, we're beating the market. We're doing even better precisely when the market has gotten hit harder. And that is despite three high profile hits to the portfolio when these are businesses that do exceptional long term. So again, we think that this will continue. We have a low beta. We are beating the market during bear markets, better cumulative and risk adjusted performance over the complete market cycle. So again, we will provide a quarterly update, with the rebalance at some point in July. That will be our next sort of update, to this portfolio. But again, we remain very, very bullish on the portfolio, especially on the ones that, companies that have gotten hit in the portfolio quite hard, and continue to be bullish on our best performers because of those big breakouts here. So again, this is exactly the type of behavior of the portfolio that we expect. And we continue to expect high performance relative to the S&P going forward, especially during volatile times. So we hope you found this helpful here. If you have any questions, please do reach out to us. We'd love to hear from you. If you are a ZRS client, please reach out to us at zrs@zacks.com. And if you are a advisor tools client, please send us an email at cat@zacks.com. All right, everyone, thanks again, and we will see you again on our next webinar. Take care, everyone. Bye-bye.